UnitedHealth is down bad, but here's why I'm still buying. And I wouldn't feel right just giving you the upside. So let's start with the ugly. First, CEO Andrew Whitty abruptly resigned, which already shook investor confidence. Then the company withheld its full-year guidance, citing in rising medical costs. That's a big red flag. And to top it off, they just posted their first earnings miss in a long time. EPS came in at $7.20, short of the $7.29 expected. Now here's what really raised eyebrows. Trump signed an executive order aimed at cutting prescription drug prices. Sounds good for consumers, but it's bad news for UnitedHealth. Why? Because it directly targets pharmacy benefit managers, or PBMs, and UnitedHealth owns one of the biggest, Optum Rx. PBMs negotiate prices between drug makers and pharmacies, and they make a ton of money doing it. This order opens the door for drug makers to sell directly to consumers, which could cut PBMs out of the process entirely. If that happens, UnitedHealth loses a big chunk of a very profitable business. So yeah, it's been a very rough year. But here's why I'm still buying. Revenue grew 9.8% year over year last quarter, hitting $109.6 billion. UnitedHealth is still one of the most diversified and dominant players in healthcare. This stock is down over 50% from its highs less than a year ago, and it's not because the business broke, but because the headlines shook confidence. And looking ahead, there's already good news on the horizon. CMS has finalized a 5.06% increase in Medicare Advantage reimbursement rates for 2026, which means UnitedHealth is set to benefit from higher payouts next year. Long term, UnitedHealth isn't going anywhere. They've weathered worse and are positioned well to continue market share domination. Follow Market Briefers for no hype breakdowns, and if you want a follow-up deep dive on Optum's model, let me know.